Is a CEO change all that was needed to turn Nike's business around, or is there simply too much competition now eating their lunch? Hey guys, hope you're doing well out there. It's time to check in with shares of Nike that are sliding nearly 5% in the after hours, despite being down close to 18% over the past 9 months. Coming into this print, shares of Nike were teetering on a level of resistance, and investors were hoping to hear some positive news, maybe some better than expected results, sending shares higher. Instead, we got some not so great results, sending shares down. And we'll highlight some levels where this one will likely settle out from a technical support level, and also some areas where you can probably step in and pick up shares. As we sit here today, shares of Nike year to date have been absolutely hammered, again down nearly 18%. And what I want you to note as an investor, it's not just the 18% loss in your money if you've invested in shares of Nike, let's say from January 1st. It's also the missed opportunity cost of investing in other stocks. Forget investing in other stocks like Nvidia, even just investing in the S&P 500 that is up, close to 20% year to date. So not only have you lost your money in Nike, you've also missed out on the opportunity cost. So the questions we have to ask is, can this company moving forward begin to outperform other names where you could invest in, or let alone even just outperform the S&P 500? Now, based on their Q1 results, that is looking pretty bleak, as revenues came in at $11.6 billion. That was down nearly 10.5% year over year, missing estimates on Wall Street by close to $50 million. Now, the first thing I want to point out is this company over the last 5 quarters, 4 of the last 5 quarters, in fact, they have missed their revenue expectations. So that is firstly a red flag and a misstep, I think, in my opinion, by exiting CEO John Donahoe. This is a man who really dropped the ball on Nike's top line growth, and that has showed over the past couple of quarters, especially over the last 5 quarters, and that is showed by Nike missing revenue estimates on Wall Street. This is a company that needs to get back to the point of beating and exceeding Wall Street expectations on that top line side. Now, from a bottom line perspective, came in with a nice 18-cent beat with GAAP EPS of close to 70 cents. And that's really what I want to point out. John Donahoe is the guy that financially engineered this company through the COVID pandemic and really beyond it, as he focused a ton on cost cutting and reducing expenses. And what that does is allows for bottom line profitability, but you can't really financial engineer your way to top line revenue growth, to top line revenue beats. You can't financially engineer your way to get people to leave their homes, go to the mall, and buy a pair of Nike running shoes. That simply happens from innovation, from new advertising, from more growth initiatives, and that's something Nike has been lacking over the past year or so. Now, from their different segments, Nike direct revenues came in at $4.7 billion. That was down 13% year over year. Wholesale revenues, this is the channel Nike largely exited after the COVID pandemic, where they shifted more towards Nike Direct. Revenues came in at $6.4 billion, down 8% year over year. Now, what they are doing well is controlling the cost of those goods, as you're still seeing gross margin expansion of nearly 120 basis points, up to 45.5%. Now, as we got Q2 guidance on the conference call, those gross margins will likely take a hit as we head on into the year. The other thing this company announced was that they're postponing their investor day. This is probably not a huge deal, simply because they are in that transition period, transitioning between CEOs, and so I'm not surprised they are postponing their investor day, likely to get some more clarity on the incoming CEO. Now, we'll get into the inventories, we'll also get into the cash and equivalents as we take a look at the financials, but the thing I want to point out is the Q2 guidance, because we got that on the conference call. Now, Q2 revenues by Nike are expected to be down roughly 8 to 10%. The estimate on Wall Street for the upcoming Q2 was for revenues to decline close to 7%. So we once again got a revenue guidance that missed analyst expectations on Wall Street. So what you're likely going to have is analysts come in and once again downgrade and re-rate the stock for the upcoming quarters. What you're also now expecting is gross margins to decline nearly 150 basis points in Q2. So like we just saw, gross margins over the past quarter did expand, and really over the past couple of years have been expanding nicely. But again, that is largely due to the fact that Nike has been sitting on a lot of inventory and really trying to move existing products, not really drive innovation and push out new products and new lines. Certainly as they look to do that, gross margins and really operating margins as well will likely take a hit. And they also mentioned for the full year, gross margins now expected to decline on a year-over-year basis. What they did say was in the second half of the year, though, they do expect a slight revenue improvement compared to the first half of the year. So similar to what Wall Street is anticipating, you're seeing larger declines in the first half of the year. So Q1, we saw a 10% revenue decline. Q2, now we're expecting another roughly 8 to 10% revenue decline. And then Q3 and Q4, you're essentially expecting flat to maybe 5% declines on those top line numbers. And so as we head along into the rest of the fiscal year, Nike's top line sales should at least meaningfully get better from a quarter over quarter perspective. Now, the other thing they did was they withdrew their full year guidance. They'll instead begin to provide quarterly guidance. That's at least for this current fiscal year. I think simply because of that CEO transition, they're in a little bit more of an uncertain phase. And so they'll transition to providing quarterly guidance. And then maybe starting next year, they'll once again resume providing full year guidance along with quarterly guidance as well. Now, the one really important line that they did acknowledge in the conference call, this was in the Q&A period, was that they acknowledged market share loss in specialty running. They said Nike is a running company, Nike is a running brand, and they have no doubt lost market share by losing focus in categories like specialty running and just overall running in general. And so just acknowledging that they have lost market share to competitors like Hoka and On, I think is a huge step for this company. I think acknowledging that they have some market share to gain in that category once again is important to see. And then also labeling themselves as a running company, as a running brand, once again, an important distinction to make, to tell their investors that yes, they are still focused on their core competency, which is the running category that still continues to drive Nike's business and likely will continue to drive it in the years ahead. They also did mention a comeback at the scale takes time. And so for me personally, I still expect the turnaround for Nike is to be at least 3 quarters away. I would at least expect the end of this year to be a pretty dismal year. And then as we look ahead to fiscal 2025, the quarters and years ahead likely will look a lot brighter. At least that is the hopes. And a lot of those hopes and dreams currently rely on the backs of Elliott Hill as he plans to return as the new CEO for Nike. So John Donahoe got the boot as he's had a pretty terrible tenure as Nike's CEO. And so Elliott Hill, a nearly 32-year Nike veteran, will resume CEO duties beginning October 13th. And then John Donahoe will not just exit the company, but he'll also leave the board of directors as well. And so hopefully Elliott Hill will be the guy to turn this business around. Certainly he has the credentials to back that up. He worked his way from an intern all the way up to now CEO. He was VP, or I believe he was actually president in 2020 of the consumer marketplace, leading the Nike and Jordan brand. So certainly he has the credentials and the tenure to back up being a CEO. He also has the support from employees as enthusiasm in the employee base has now once again resumed. And so while the future does look promising, we still have to wait and see, because look, turning around a business like Nike, certainly no easy task, even for a seasoned veteran like Elliott Hill himself. Now, in terms of Q1 divisional revenues, it's basically bleak across the board as North America overall declined nearly 11%. That's both on a constant currency and reported basis. You saw their largest segment, the footwear business, decline nearly 14%. And so when management on their conference call address that Nike is a running company, Nike is a running brand, and they acknowledge market share loss in the running category, that speaks volumes to me, because they're acknowledging that this 14% is not due to consumer weakness. It's in fact due to Nike themselves losing focus and allowing competitors to come in there and take away market share in the footwear category across the globe. And so that is important to me, because it shows me that they're focused on turning this business around, once again growing on the footwear business. On the apparel side, you saw 10% declines in revenue. The equipment business remaining relatively strong and has been for quite some time, but makes up a very small portion of Nike's overall business. Similar story in Europe, as you saw footwear declining 12%, apparel declining 11%. Greater China, the all-important Greater China region, is proving to be a bit stronger, as footwear down just 2% and then apparel down just 9%. That's on a foreign exchange neutral basis. On a reported basis, slightly worse at 3% declines on the footwear side and then 10% declines on the apparel side. APAC and Latin America, similar declines in 3% on the footwear and then 2% in apparel. This company also is still wholly owning the Converse brand, and there's really been no innovation in that line for quite some time. And yeah, the numbers show it. As you've seen, Converse revenues really decline pretty steadily over the past couple of years. From a statement of income perspective, total revenues we saw down 10%. Their cost of sales declining right around 12%, so still doing a relatively good job. But keep in mind, a lot of these cost of sales not really Nike going out and manufacturing a lot of their shoes in this quarter. In fact, a lot of that is inventory that's already been sitting there. And so a lot of these revenues are coming on the heels of existing inventory actually sitting there. And so with that reason, yeah, it should be, I guess, expected that cost of sales should rather be down faster than revenues, simply because this company is focusing on moving through existing inventory rather than trying to manufacture and ship and produce existing inventory. And so gross profits declining nearly 8%, not as bad as your total revenues, again allowing your gross margins to expand in this quarter. But like we got commentary from management, that shouldn't be expected for the remainder of the year, as you should likely see gross margins declining over the remainder of the year. But as an investor, I would much rather see a focus in trying to expand top line revenues while maybe giving up some gross margin percent in the near term. I think anytime you're focused on squeezing out as much gross margin as you can at the expense of losing revenues, that is a recipe for disaster over a long period of time. And that's certainly what we've seen with Nike over the past 5 years. Now, demand creation expense coming up to $1.22 billion, up nearly 15%. This is actually a figure I like to see Nike spending on. This is what makes Nike. They need to continue to advertise, continue to pay those world-class athletes, and get those on the Nike and Jordan brand. This is what differentiates Nike from their competitors like Lululemon, like Hoka, like On, because no one can spend as much as Nike can on their marketing budgets. And so this is a line item where I like to see Nike push the pedal and really drive greater and greater demand creation expenses, because at some point, as long as those marketing campaigns hit the nerve and hit consumers in the right place, those will drive top line revenue sales like they once used to, at least over at Nike. Operating overhead up to down to $2.8 billion, down nearly 7%. This is a part where I do certainly like to see Nike control those operating expenses, and part of this is due to that cost reduction and really employee workforce reduction as well. And so despite controlling costs as best as they could, the 10% decline in revenues certainly does show up in the bottom line, as your net income declined nearly 28% and your EPS declining close to 26% year over year. Now, this company is doing a fair amount of buybacks, so part of that EPS is bolstered up by a little bit of a buyback that you can likely still continue to expect over at Nike. They have remaining $8 billion authorized for the share repurchase program. From the balance sheet, it's looking decent, not great, but certainly not bad in any case over at Nike. Current assets, cash and cash equivalents coming in at nearly $8.5 billion. That was up nicely, close to 40% year over year. Some of that looks like is from short-term investments moving into cash and equivalents. Now, the important line item to note for Nike is the inventory figure. As you saw, inventories down roughly 5% year over year, coming down to $8.2 billion. On the conference call, they did mention that there was heavier promotional spend, and so they're likely continuing to move through that inventory, likely marking it down, again, causing those revenues to decline year over year, as they're likely having to move through those inventories on higher and higher markdowns. The aim for Nike should be to get to a point where they're able to control inventory and rather maintain it without having to move through it with the help of higher promotional spend and higher markdowns. From a liabilities perspective, all things looking in line, you have roughly $8.9 billion in long-term and short-term debt combined. Roughly $1 billion of that is in the short-term portion, payable over the next 12 months over at Nike. So certainly from a cash to debt perspective, they're looking still relatively fine. And from a current assets to current liabilities perspective, still having well in excess current assets than liabilities on the balance sheet. Overall, this quarter, I think, came in as expected. I think by most people, it's a pretty abysmal quarter, but that is what Nike guided for in the previous quarter, as they anticipated total revenues to be down 10%, and that's exactly where they came in. In terms of the guide for Q2, that came in a bit worse than anticipated. Likely that is what's causing shares to be lower in the after hours. That Q2 revenue now expected to decline roughly 8 to 10%. Certainly not a good look, but as you have an incoming CEO who really has a knowledge of this company like no one out there, maybe other than Phil Knight, it's the question that can Elliott Hill now come in and turn this business around? That is the one we have to, I guess, wait to find out. Now, from a technical perspective, shares of Nike over the past couple of months have been on a steady decline downwards, really highlighted by this downtrending channel of lower highs and lower lows. Coming into this print, shares were actually trading up closer to the top end of the range, and so the path of least resistance for shares of Nike at this point, unfortunately, is actually lower And based on the results that we just got, nothing was really out of the ordinary, nothing was spectacular by any stretch of the imagination. And so I certainly wouldn't be surprised if shares of Nike continue to stay within this channel and then continue to head lower. I think the first level of support you can probably find is once again back here down at the 70s. That's where you'll once again be meeting this long-term level of support that I think at one point or another, I do expect shares of Nike to once again retrace into. That would take you all the way down to the 60s, believe it or not. And so for that reason, am I eager to step in and buy this drop in shares of Nike? No, not really. One, because from a fundamental perspective, I think this company still has a long way to turn around their business. Like I said, at least 3 quarters in my opinion. I think from a technical perspective also, you have a fair amount of resistance at this level, and so I certainly do expect shares of Nike to continue to head lower. Now, in the off chance that they do once again enter this uptrending support of basically higher highs and higher lows that we've seen over the past 30 years, this nearly 30-year uptrend, if Nike can once again get back into it, I think at that point you probably have more of a reason from a technical perspective at least to begin to allocate more shares in Nike. But certainly in the near term, in the short term, I do expect shares to trade underneath this nearly 30-year uptrend, come back somewhere in the 70s, if not lower in the 60s. That is a point where I think if you're still a long-term investor, long-term believer in the vision that Nike has, I think that's a great place for you to pick up more shares in this company aggressively. At least in the current time, I'm not going to be a buyer. I'm going to wait to see what the new CEO, Elliott Hill, really has in store, what his plans are, and how he plans to turn this business around. I want to take a wait and see approach as it pertains to Nike. And so for that reason, while I'm not currently selling my shares, I'm also not buying more aggressively. I'm sort of just on the sidelines with this company for now. Let me know your thoughts on this one in the comment section below. A phenomenal business over the past 30 years that we've seen, but more recently over the past, call it 4 to 5 years, there's been some missteps taken by existing management that's now on their way out. And as the new CEO steps in, he has a tall task ahead of himself, but maybe based on his credentials, maybe based on his 32-year tenure at Nike, he is the right guy to take charge of this company and really move it forward. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.